American serial entrepreneur Luni Libes is copying elements of the Warren Buffett Playbook to invest in African agribusiness companies. His investment holding company, Africa Eats, recently listed on the stock exchange of Mauritius. It has stakes in 22 African companies, ranging from a fruit and vegetable business in Tanzania to a meat processing venture in Rwanda. I'm Yaku Maritz, founder of How We Made It in Africa. Let's listen to a clip from our interview with Luni Libes where he describes how Africa Eats plans to make money for its investors. To listen to the entire interview, click the link in the description. How We Made It in Africa's full, in-depth interviews with entrepreneurs and investors in Africa are only available on our website. And to access all our interviews since 2010 and support our work, I also encourage you to become a How We Made It in Africa member. Our YouTube audience gets a 15% discount. Check the description below for the discount code and the sign-up link. Please also hit the subscribe button below to never miss a video. Okay, enough with that. Let's watch the clip.
I've read that you've modeled Africa Eats' investment philosophy, strategy, whatever you want to call it, loosely on Berkshire Hathaway. Can you maybe elaborate on that a bit?
Okay, just a little bit. I do have the book. So my co-founder and I published this a few months ago.
Wow.
It's called Berkshire Africa, if you missed the title there. We took three ideas. So Africa Eats uses a business model that we didn't see anywhere else. We were not only trying to solve in the short term hunger problems, which didn't happen, but the pandemic was almost a non-issue in Africa. Nobody starved because of that. They starved for other reasons. So we were trying to solve a different problem, which is how do you invest in Africa in the long term, which is a continent full of countries that don't have a history of exits. So the VC model requires exits. So we can't simply follow the VC model. The PE model, the private equity model, requires exits. Can't follow their model either. The banking model doesn't work. Like there just isn't a model for us to follow. So we said, well, what if we follow the Berkshire Hathaway model in general with some twists? So first thing that's different is we're investing in young, fast-growing companies. Warren doesn't do that. Warren Buffett has never invested in a young company in the whole history, a 60-year history of Berkshire Hathaway. So we're already off topic there, but that's what we do. So we're a little VC-like in that case. We are a lot more hands-on in the growth of these companies. That comes out of the Fledge part. So they all got born basically as real companies in the accelerator, as established formal companies in the accelerator. We do a lot more work with them to make them even more formal and to help them scale up. So we think of this as a growth stage accelerator. That's not Berkshire Hathaway like either. The third thing we do is very much like them, which is once we found a company and we make an investment, we have no plans of ever selling that investment. So there's literally a Warren Buffett quote he said many times, which is, we think the best holding period is forever. And this is dramatically different from all the other investors because a VC or a PE fund, by definition, is a 10-year fund or whatever they pick, but generally 10-year fund. And as soon as they make the investment, they know when they have to exit. And they're starting to think about, well, but even before they make the investment, how do we get out of this investment? And our mindset is completely different, which is, well, we like this company. We're going to put more money in this company. And what do you think it's going to look like in 20 or 30 years? Like, how big do you think it's going to be? How many countries do you think it's going to be operating in? What else do you think we're going to be helping this company with in 30 years or 40 years or 50 years? Which of these in the portfolio do you think are going to be the largest companies in the portfolio or in their country in 20 or 30 years? We have this very long-term mindset. And that changes the way we invest in them. And so between those three pieces, just like Berkshire Hathaway, our default is yes. If they come to us needing something, our default isn't, okay, show me all, check all these boxes. And if you don't, we're going to just toss it in the garbage like the VC, the PE firms do. No, it's much more of you are part of our company. Africa Eats is not the HQ that is a small team. Africa Eats is all the companies. and the headquarters, despite the fact we only own a minority in them. So we're not a conglomerate, and we don't control them, but they're still part of Africa Eats. Africa Eats is the sum of all the parts. And so when they come to us with any ask, our default is yes. We just have to figure out, is everything they're asking correct? Like it makes sense, or do we need to sit down with them and fix it? And that's exactly the mindset of an accelerator, where every company that applies to an accelerator is flawed in some way. If they weren't, they wouldn't apply to the accelerator. So our job in the Fledge Accelerator was to figure out what flaw they had, decide whether we could fix it, and decide whether they were the best companies once fixed. And in Africa Eats, we look at their ask, we question everything we can about it, and then when we're satisfied, we say yes. And then knowingly we say yes, knowing that they probably still missed something and we probably still missed something. So let's just literally, we'll do this in the call in our weekly call with the management team. How much should we put aside for what we missed? Like we'll budget the unexpected expected misses. And I'm talking about, we forgot about this spare part that's likely to break. We forgot about this time frame is a little bit too quick. We forgot that things go wrong, and sometimes we have to fly in experts to help tune equipment. Like things you can't predict in the beginning on what's going to go wrong. We know things are going to go wrong, so we just keep a slush fund for that.
Okay, so the Africa Eats listed, I think, about a month ago, if I'm correct.
This month actually was 3 weeks ago today.
Okay, so was the intention from the beginning to list it?
Yes, before the beginning. The business plan always said we will be a public company. And it said, when it got written in 2019 or 2018, it said we will be a public company in Africa in 2024 or 2025. So we hit our big deadline. And we did not go public to exit. So we did not go public to let our investors all sell out and be done. We went public because it opens a new door for new capital and new investors. So we raised money in this path. We didn't sell anything, and two of our companies went public on the same day. First two of our investees of many to come, and we didn't sell any of those shares either, nor do we intend to sell those shares. I said best holding period is forever. They went and listed because that provided them a path to raise $600,000 and $800,000.
Yeah, this model, it's. What do you think are the opportunities for a similar listed holding company, maybe focusing on other sectors like, I don't know, manufacturing, or maybe providing an exit opportunity for all these VC-backed tech companies, maybe take like the ones that are profitable and putting them into a holding company and listing it? Because I mean, in South Africa, there's quite a few holding companies like this, but you still see far more in the rest of Sub-Saharan Africa private equity funds than I see companies like this. So yeah, what are your thoughts on replicating this in other industries, and what is kind of needed to get this right? Because listening to you, it sounds very easy in a way, but I suppose it's not.
Not easy. Okay, so we didn't call the book Africa Eats on purpose, like not just because we wanted the word Berkshire in there, but we called the book Berkshire Africa. That is the name of we call the business model, and in here it says, like, please replicate this in other sectors. Like it should work in other sectors too. There is a copycat of Africa Eats called Africa Trees that is owned by a nonprofit that I started. Different sector, same geography. And I think one day it'll follow in the same footsteps, but it's not quite there yet. It's newer. We think no one's done this before for many reasons. One is The norm is you take one winner, and generally a VC or PE fund will have like one big winner, maybe two. We have 7 that could go public. If the capital markets had enough capital in them for these types of companies, we would have listed 7 this year. The capital markets don't know this section. They're confused about what we did as well. It'll take them time to understand. So we only listed 2. Um, so most of the time, the investors already have a structure where they just need those exits. They look at these IPOs as their exit. And if you look at the history of companies going public in Africa, that doesn't generally work. There just isn't enough money in the capital market that's interested in taking out the investors. Like all the money we raised in this round with these 3 companies went into the companies. It didn't sell. It didn't let any investors leave. Right. So all the money is going to turn into more growth. So that's part A, right? The investor would have to have the mindset that this is just a step toward them exiting way in the future when the company's much, much bigger, right? Probably in a share buyback, with profits. 2 is we didn't just go to the stock market and list. I called up the stock market 14 months and 3 weeks ago and had a conversation with the CEO and said, wouldn't it be great if there was a segment on your stock market specifically for fast growing profitable companies, right? That's harder to get on the segment than normal, so that the institutional investors that are in the capital markets would have the comfort that we're not watering down the rules like they often do. Every stock market has a sub board. We're not
Yeah.
interested in sub boards and lesser. We're interested in greater. These are super high quality companies that grow like nothing on the stock markets. And because we have that, that's what our companies do. Again, we have 7 of them. And then we discussed, and we went to Mauritius and chatted with the institutions and asked them, which should we bring first, the largest or the smallest, or a mix of them? And we decided on the smallest. But that was the better path to prove this out. So we said, great, okay, we'll take these 2, we'll prep them. And then the third one is that we brought a third option to the table, which is not any specific one company, but investing in all of them, which is what Africa Eats is. Without a timeline, without some artificial piece of we have to exit all of these investments by 2020, whatever. Without that piece, Africa Eats is going to be around for hopefully hundreds of years. Invest in it. You are then buying a piece of all these companies, and then when the success stories go public, the value of Africa Eats goes up. Right, the value of our investments go up. More of the institutions invested in Africa Eats than the individual companies. We think when we get to 5 or 6 or 7 listings and get to an index where perhaps we can make an index fund, then they'll invest in the individual companies. But as we did these roadshows in multiple cities, they were a little wary of investing in a $8 million market cap chicken processor. That was a little scary to them. That's a little too small. But some of them did. Like they did get an institutional investor that said, yeah, I want that one.
Okay. And so in terms of, do you take like management fees, or how do you pay for your own activities and management involved in these companies?
Yeah. So HQ is 3 full-time staff. So step 1 is, again, learning from Berkshire Hathaway. It is the 7th most valuable public company in the United States, 8th most valuable in the world. Right? It's a $1 trillion company. Their headquarters in Omaha, Nebraska has 25 people in it. They run a $1 trillion company with 25 people. And Warren Buffett will tell you, if you listen to what he says, he spends most of his days reading. He doesn't manage. And then there's a few people who pick stocks. Like I think half the 25 people are actually stock pickers, like a brokerage house, in-house brokerage house. So we just have 3. So we keep the costs down in HQ. That's step 1. Step 2 is, at the moment, we have a little trickle of income that pays for that, but it's not enough to pay for the whole team. So we are spending investor money on the team at the moment. That will change in time. We have plans on income streams, but no, we don't charge a management fee to our companies. It's actually the opposite. So there are many times during the year where they have an ask and they have a need, and it doesn't really fit the equity model of investing, nor does it make sense to lend them the money. So we will take on costs of our companies. For instance, they need to hire that great new operations person, but they can't quite afford them yet. And then we're talking about the middle stage companies. So we'll just do a deal. We'll say, great, we'll help you interview. We'll help you find that person. We'll pay for them for the next 6 months or the first 6 months. And then you take them on after that. You should be big enough. And we'll sit there with a spreadsheet, whether it's 5 months or 9 months or whatever, and come up with an exact number. We'll start off paying them. And no, that's kind of an anti-management fee. Like that's on our it comes off of our balance sheet. But the reason it's the right choice is that it makes the company generally 50, 60, 70, 80, 100 times bigger in terms of revenue and value. And so the value of our shares go way up. And since we're going to own that forever, great, we're just getting a more valuable asset in the long term. So if you think about it from the investor point of view, it doesn't matter whether we spend the money on staff or those expenses or an equity investment or a debt investment once we have a significant portion of equity in a company. Once we own 25% of a company, if we can get them on this growth track of 50% per year growth, yeah, it's a rounding error on how we invested the next dollar.
And do the individual portfolio companies pay dividends to Africa Eats?
Not yet. So they will when they have so much money coming in from profits that they can't spend it all growing the companies. But we haven't seen the chart here. The 10-year track record of these companies is growth from $600,000 total across all the companies that existed in 2014 to 36 million last year. We'll be past 40 million this year, close to 50. Not close to 50, but past 40. That is a compounded growth rate of 52%. They've been growing as a whole, as a collection, at an average growth rate of 52% per year for 10 years. So and again, compared to Berkshire Hathaway, where the normal growth rate of one of their companies is 2 or 3 or 4, and 5 is a really fast growing company. So in terms of like the style of the portfolio, it's vastly different. And so our benchmark is 52%. If a company can grow 52%, then they're keeping up our average. And our success stories are generally growing at 40, 50, 60, 80, 120%, over the last few years.